if you want to watch the class later, you join the same way you joined the session. You click on the big blue button, and then down there you will see a recording with the statistics of those who are in class. So remember, we are going to have two sessions, the live session which we have started, and also we will also have the discussion forum, and I'll be taking attendance in both the cases. So please ensure that you contribute in the two sessions, and you're free to ask any question or any clarification at any given time. So let us start by defining a contingency. Let us start by defining a contingency. Now, a contingency is simply an existing condition. It is simply an existing condition involving uncertainty as to a possible gain or loss to an enterprise, as to a possible gain or loss to an enterprise that will ultimately be resolved when one or more future events occur or fail to occur. So those are the conditions. The future events may occur, or it may also fail to occur. So that is the definition of a contingency. And the contingencies can be classified as either loss contingencies. They are classified as either one, we can have the loss contingencies, and we can also classify them as gain contingencies. We can also have the gain contingencies. About my handwriting. Gain contingencies, and the loss contingencies are the major source of contingent liabilities. The loss contingencies are the major source of contingent liabilities, and they occur when an uncertain existing condition, situation, or set of circumstances will be resolved by the occurrence or non-occurrence of a future event. So the loss contingencies occur when an uncertain. So we are talking about, maybe I can put it down there, an uncertain. They occur when an uncertain existing condition or situation or even a set of circumstances will be resolved by the occurrence or non-occurrence of a future event. So an example that we can give is the receivables. The receivables, I hope we all know what receivables are. The other name for receivables are the debtors. Then we may also have the items like the warranties. So we will also look at them in details. Now, when the loss contingency exists, then there is a likelihood that a future event, there is a likelihood that a future event or events will confirm the impairment of an asset or the incurrence of a liability, and this can range from very likely to very unlikely. It can range from very likely to very unlikely. So very likely means that the event it is all, the probability of the event occurring is almost 1. And very unlikely is that the probability of that event not occurring is almost close to 0. So that is the situations. But the FASB, and I hope you know AFASB, it has identified 3 levels of likelihoods that may occur in an event. The first likelihood is probable. Probable. The first likelihood is probable. The first likelihood, probable. Now, in this likelihood, in this situation, it means that the event is likely to occur. The event is likely to occur. Now for the probable. Then the second likelihood is reasonably possible. Reasonably possible. Now for this case, you will find that now the chance that the future event will occur, the chance that the future event will occur is more than remote. Remote is the next likelihood, is more than remote but less than probable. Is more than remote but less than probable. So the remote likelihood means that the chance that a future event will occur is very minimal, or it is slight. So number 3, we have got the remote. Now for the remote likelihood, it means that the chance that a future event will occur is slight, or it is very minimal. Now, the accounting treatment for the particular loss contingency depends in part on whether the related future event has a probable, which we have looked at, has a probable, or it has reasonably possible, or the remote chance confirming an impairment of an asset or incurrence of liability. So we are talking about impairment of asset, impairment of an asset or just of asset. Then we are also talking of incurrence of a liability. Incurrence of a liability. Impairment of an asset or incurrence of an liability. Now, there are three ways to account for and report. There are three ways to account for and report loss contingencies. Now, the first way is the accrual of an estimated loss, accrual of an estimated loss from the contingency, which should be reported in the financial statements. Number two, we have the disclosure, but not accrual of the loss contingencies. And then three, we have neither an accrual nor the disclosure of the loss contingencies. So those are three ways that we can look at. So I want us to look at the loss contingencies that should be accrued. The loss contingencies that could be accrued. Loss contingencies that could be accrued. Loss contingencies that could be accrued, and then we'll try to look at the accounting treatments. Now, an estimated loss from a contingencies should be accrued if certain conditions are met. Now, the first condition is that the information that is available before issuance of the financial statements should indicate that it is probable, that an asset has been impaired or a liability has been incurred. So that is the first condition, that the information available before issuance of the financial statements indicates that it is probable that an asset has been impaired or a liability has been incurred. So that is the first condition. Number two, the second condition is that the amount of loss can be reasonably be estimated. So you should be in a position to estimate the amount of loss that will occur. That is the second condition. So one, the information should indicate that it is probable that an asset has been impaired or a liability has been incurred. Number two, the amount of loss can also be reasonably be estimated. So it should not be something that you cannot uh, estimate. Now, there are some situations when condition one is met, now the information that is available, but only a range of loss can be reasonably be estimated in response now to our second conditions. Maybe for an example, if we give an example of an unfavorable verdict on a lawsuit against a company, which might be probable, it might be probable, the lawsuit, you may not know the outcome or the verdict, but now the amount of loss can be estimated to be in a range, maybe from 1 million to 2 million. Now, in that situation, when some amount within the range appears to be a better estimate of the loss than any other amount within the range, then that amount should be accrued by a charge to an income. So you take an estimate in that case. You just take an estimate. Now, I want us to look at the contingencies one by one. We were just looking at the contingencies in general. And the first contingencies that we want to look at are the guarantees, guarantees, the guarantees and warranties. Guarantees and warranties. Now, if I may ask, what is a guarantee? So you can unmute your microphone and maybe you tell us what is a guarantee. Guarantees and warranties. Just unmute your microphone and then you tell us. Guarantees and warranties. Anybody with an idea? Yes? Anybody with an idea of what a guarantee is? Wedi Kawira, I'm seeing Wedi writing something. Guarantee. A guarantee is simply an assurance that maybe a certain condition will be fulfilled, especially that a product will be repaired or replaced. A product will be repaired or replaced if it is not of maybe of a specified quality. That is a guarantee. Now, a warranty is given for, it is just the same, but now for a specified period of time, maybe in the next 1 year or in the next 2 months. If anything happens to the product that you have bought from us, they will take the liability. Now, you will find that most of the products and the services are usually accompanied by a guarantee or a warranty that the product or the service will be. Yes, Wendy. Yes, Kawira.
Yeah.
Yes, you wanted to say something.
No, my network and a problem.
Okay. So I'm saying that for most products and services are accompanied by a guarantee or a warranty that the product or the service will be advertised and that it is free of defects. So the guarantees and warranties typically are effective for some limited period of time. Like we have said, it can be for 1 week, it can be for 1 year, it can be for 2 years, depending on now the product that you or the service that you are getting from your supplier or from the seller. And the period must be stated. So if maybe the product is having some defects within that period, then it is the company to take liability of the product. So the liability may mean that the company or the seller is willing to repair or even replace the product without any charge, or they will refund some or even more than the original purchase price of the product. So these, the guarantees and the warranties, they create a loss contingencies because there is an existing circumstance. Now the seller can usually estimate based on the past experience of the potential warranty expense that will be associated with the total sales occurring during a given period. So the sellers are in a position to estimate. They are in a position to estimate now the amount in the guarantees, depending on now on the past experience, because you can simply know that now from if you have been in operation for even 10 years, you can know that now in year 1 these were the contingencies arising from the guarantees. You can know in year 2, year 3, so that now from the 10th year you can give an estimate now of the amount of loss that you have. Okay, so we can move on to an accounting illustration of how we can treat the guarantees and warranties. So for example, we are told that Turesia Limited, just a name, we are told that Turesia Limited sold 10 drill press. We have 10 sold 10 drill press We sold 10 drill press during July for 3,000 shillings each. So at 3,000 shillings. So I hope you guys are having your calculators. We sold 10 drill press for 3,000 shillings each. And the past experience has been that a warranty expense is equal to 2% of sales. So from the past experience, the warranty expense is 2% of sales. 2% of sales. Now we are told to prepare the entries to record the aggregate sales and the estimated warranty expense and liability for July. We are told to prepare the aggregate sales and the estimated warranty expense and liability for July. So first of all, we have to calculate the amount that we are expecting to get from the sales by now multiplying the 10 drills that were sold by the purchase price, which is 3,000 shillings. So we'll have now the sales revenue just the sales revenue. Now we'll have 10 drills that were sold. Then we are multiplying this by 3,000. So please, I expect that in the public chat, you'll be writing the product there. So what will this give us? What will that give us? I'm waiting in the chat there just to ensure that we are together. Please, 10 times 3,000. Wedi, Mzungu, 30,000. Okay. Margaret, Kinyua, 30,000. So this will be 30,000. So that is Roy, Ombo, Dennis, Kipkech. Okay, we are together. Now that will be 30,000 in sales. So again, we have also to calculate now the warranty, the estimated warranty expense. And that will calculate by multiplying the sales, which was 30,000 by 2%. So again, I'm waiting for the product there. So warranty expense. The warranty expense. Now this will get by having 2 out of 100. Yes, Wedi 600, Margaret 600, Rua 600, Kipkech 600. Rombo, sorry, not Rombo, but Roy Ombo. sorry. Kinyua 600. So this will be 600 as our warranty expense. So once you have done that, now you will make the accounting entries. Now for the first transaction, when we sell the drills for 30,000 shillings, now what we will do, we will debit cash. So we'll have cash. We debit cash 30,000. We debit cash 30,000, and then we will credit. Remember, a transaction always affects two accounts. Like if we sell the items in cash, it means that now cash will be affected and the sales will also be affected. So we debit cash and then we credit the sales revenue, or we just credit the sales. So we credit sales 30,000. And remember, this amount is from the sales revenue. And we have already shown here how we have arrived at the 30,000 shillings. Now for the warranty expense, expense, now the entry that we are going to make there is that when you have the estimated warranty expense, now we will debit the estimated warranty expense and we credit the estimated warranty liability. So we debit estimated warranty expense, and we have also got that amount as 600 by multiplying 2% by the 30,000, the sales revenue. So estimated warranty expense warranty expense because we have this is just to recognize the expense that we will incur. So that was 600. You debit 600. And then now we credit the estimated warranty liability. So we credit estimated, let me write in short, estimated warranty liability. So again, that will be 600. So that is the accounting entry that we are to make. Now, if, for example, that the actual cost now is 300 shillings that is incurred when the warranty work is done, then now this cost may be recorded, assuming that we incur a warranty of 300. For example, remember these are just the estimates based on the past history or past experience. Now, if in actual case we incur a warranty of 300 shillings, for example, then now to record this, we will now debit the warranty liability. We debit the estimated warranty liability, so we can show that. We debit estimated warranty liability. Write in short to have time. So we'll debit it with 300, the actual warranty incurred, and then now you will credit maybe the wages payable. If it is a repair, for example, if you have repaired the product and you are paying the person who has repaired the product, then now we can credit the wages if it is a repair. So we can have the 300 there. We credit. Cosmas, please mute your microphone. I'm trying to mute and you keep on coming again. So we credit the wages if it is a repair. Now, if it is a part that you have replaced, maybe it is somebody sold a vehicle, for example, and then you realize that maybe the tires have got a problem and you take it back to them and they replace the tires, then now what we will credit there is now the parts inventory, parts inventory. You credit parts inventory, and if you have maybe used the customer repaired the item on his or her own, and he has used a certain amount of money, and you are refunding that amount, so what we will credit here will now be cash. So it depends on now the nature of the warranty that you will give to your customers. I hope we are clear on how we treat the warranties and the guarantees, because they are the same. Number 2, we have premiums and coupons. Number 2, we have premiums and coupons. Premiums and coupons. Now, it is usually fairly a common practice for sellers, the wholesalers, the retailers, even manufacturers to give premiums such as cash or merchandise to their customers, or merchandise to their customers in exchange of coupons, wrappers, and many others that accompany the purchased merchandise. Now, since the motive of the premiums or the coupons is to increase the sales, now the matching principle requires that these expenses be included in the period of sales. The matching principle requires that these expenses be included in the period of sales. You have seen, maybe if you go to a supermarket, for example, you are told that if you buy maybe Omo, for example, Omo worth maybe Omo of 2 kilograms size, then you are given maybe 10 grams of a tomato paste or 10 grams of a soap and so that. So that is what we call now the premium and the coupon. Remember that their cost should also be included. They are not free. The motive is to increase the sales. Because when you are told that when you buy this product, give you an additional product, you'll find that now instead of going to supermarket X, you'll stick to supermarket Y, which you are a premium. So we can also look at an example. Now, assume that Nakuru Limited has offered an official size football. So we have Nakuru Limited, and it is offering an official size football in exchange for 10 cereal box tops. So if you buy 10 boxes, you get one football. You get one football ball. Or simply you get one ball. So it is one, not seven. So when you buy 10 boxes, you get one ball. Now, plus, so one ball plus 10 shillings. You are given 10 bob. One ball plus 10 shillings. Now, assume that a total of 100,000 boxes, assume that 100,000 boxes were sold. So 100K boxes were sold. Assume that 100,000 boxes were sold for 3 shillings each. So at 3 bob. Sorry, my 3 is not promising enough. So at 3 shillings each during an accounting period, and that the estimates are that 40% of the boxes will be turned in for footballs. So 40% of boxes will be turned into balls. So let us just call them balls. 40% of the boxes will be turned into balls. Full stop. Nakuru Limited must obtain an inventory of footballs to be given out as premiums. Then we are also told that we assume that Nakuru Limited acquired 5,000. They acquired 5,000 balls. 5,000 balls. Now that was their estimate. They acquired 5,000 balls at 12.5 shillings. 12.5 shillings. So please, it is shillings. You don't draw the sticks. 12.5 shillings for this purpose. Now we are told to prepare the entry to record this acquisition. Record the entries to record this acquisition. Now the first of all, we are told that for every 10 boxes, we expect that what will be given in premiums and coupons is either one ball or the 10 shillings. Then we are told that the Nakuru Limited acquired, they sold 100,000 boxes at 3 shillings each. And based on the first experience, 40% of the balls will be turned in, and then the company acquired 5,000 balls at 12.5 shillings. So first of all, we can record the entries of Nakuru Limited acquiring the 5,000 balls. Now, when they acquire the 5,000 balls, the entries to be made, because they are buying, it means that cash will be spent. Remember, cash has got a debit normal balance. So any increase is debited and any decrease is credited. So it means that now, when we are acquiring the 5,000 balls, we are going to debit the inventory of the premiums now. We debit the inventory and we credit the cash. So can you multiply 5,000 by 12 and then you give me the product? So we will debit inventory premium. That is the first entry. Yes, Kawira, 62,500. 62 from Rua. The inventory premium. Dennis Kipkech, 62. Inua, 62,500. So we will have 62,500. We debit inventory premium. Then now for the cash, we credit 62,500. So that is the entry that we will make now to recognize the purchase of the 5,000 balls. So this, how we have obtained that, we have multiplied 12.5 for your reference now times 5,000, and we have been able to get the 62,500. Yes. So that is the first entry that we are making. Number two, we can also make an entry to record the sales of the 100,000 boxes at 3 shillings each. So now when we make the sales, remember, when we are selling, we receive the cash. Cash has got a debit normal balance. So any increase is debited, and sales has got a credit normal balance. So any increase in sales is credited. So to record the sales of 100,000 boxes, we will now debit cash. So again, you can multiply the 100,000 by 3. So we debit cash, multiply 100,000 by 3 for the sales, and we credit sales. Yes, Said, 300,000. Prudence Mithika, welcome. 300,000. Dennis Kipkech. Hassan Kinyua. So that is 300,000. And then we credit sales 300,000. So that is now to recognize the sales that were made. Okay. we continue. So that is the problem that we have there. Now, for the 100,000 boxes, remember, we said that only 40% will be turned in for football. And we must also note that in conjunction with the current period's sales, estimated premium expense will be debited for 2.5 per football cost, in excess of the 10 shillings charge to the customer. For now, the 40% of 100,000, 40% of the 100,000, no, not 100,000. Remember, the balls here are 5,000. But if you take the 40% of the balls here, you will know the number of balls that we will have. Now, the redemption of now the boxes, and the receipt of now the amount of money in exchange for the balls, we can also record that. Remember that we are told that out of, let me get the question again. I can post it, share it with you. You check. Let me see if I can. Yes, you check from the chat there, so that you have posted it there, so that you get what we are saying. We are told that assume that Nakuru Limited offered an official size football in exchange of 10 super serial box tops plus 10 shillings. And we assume that a total of 100,000 boxes of super serial were sold for 3 shillings each during the accounting period, and that estimates are that 40% of box tops will be turned in for football. Now, we are also told that Nakuru Limited must obtain an inventory of footballs to be given out as premiums, and also that they have acquired 5,000 footballs at 12.5 each. So that is the problem that we have there. So we have already recorded the entries for acquisition of the 5,000 balls, and we have also recorded the entry to in recognition of the sales revenue for the 100,000 boxes, which we have done. But now what I want us to do is now to get now the 40%. If you look at the problem there, we are told that 40% of box tops will be turned in for footballs. So can we get 40% of 100,000 boxes? So what will that give us? Yes, I'm waiting. Wait, 40,000 boxes. Can you read the problem again? Remember, we were told that for every 10 serial, for every 10 boxes, we are getting one ball. So maybe we can illustrate that in the next slide. We have 100,000 boxes. We have 100,000 boxes. Now, out of these 100,000 boxes, what will be given out in maybe as premiums will be for every 10 of them. For every 10 of them, we are giving one ball. So it means that now, for the 100,000, now the number of balls that we are expecting to give will be 10,000 balls. That is one. Eh? So 10,000 balls. That is our estimate. Now, if we sell this, if we sell all the 100,000, we are expecting that customers will give, we will give them the 10,000 balls. But remember, our estimate again is that only 40%, only 40% will be turned in for footballs. So the number of balls that we are expecting will be 40%. Now we multiply 40% of the 10,000 balls. 40% of the 10,000, and which is 4,000. Yes, Dennis. So the number of balls that we are hoping to be turned in will be 4,000. I hope we are clear there. If there is a question, you can unmute your microphone or you can post it. So we have 4,000 footballs. That is what we are expecting that the customers will give out. Now, if, for example, that we are expecting the customers to redeem now these 4,000 the 4,000 balls, then it means that the sales that would have made in such a case will be for 40,000 boxes. Remember that the selling price of each box, the selling price of each box is 3 shillings for each box. The selling price of each box is 3 shillings. So if we are selling 40,000, then it means that the total sales will be 40,000. Okay, let me repeat. Now we are talking about selling 100,000 boxes. Now we are told that now, for if we sell 100,000 boxes, we have a premium or a coupon that we are going to give to our customers, that for every 10 boxes that we are selling, we are giving one ball. We are giving one official size football in exchange of 10 box tops plus 10 shillings. So it means that now, when we are selling the 100,000 boxes, now the number of footballs that we will give out is what now we are being asked now. How do we get the number of footballs? Now we can say that if 10 boxes is equivalent to 1 ball, if 10 boxes is equivalent to 1 ball. Now, therefore, 100,000 boxes now will be equal to, now we'll take the 100,000 multiplied by 1, we multiply it by 1, and then we divide it by 10. So we divide this by 10. So if we multiply that, the 0 there will go with the 0, and then we'll have 10,000 boxes. Not boxes, but footballs. So it means that now, if we sell the 1,000, if we sell the 100,000 boxes, now what we are supposed to give in coupons will be 10,000 balls. That is our estimate. Remember, there are some customers who will not be willing to take the coupon. They will not be willing to take the balls because maybe in one way or another they don't need the balls. So from the estimates, we have estimated that only 40% will be turned in for the balls. So the 40%, we can multiply it directly from here. We just take 40% of the 10,000 balls, or we can go through a way of, first of all, taking the 40% of 100,000, and then we get 40,000. So we say that now 40,000 boxes are the ones that will be turned in for balls. And remember, for every 10 boxes, we get 1 ball. So you will divide the 40,000 by 10. So if you divide that, you will get 4,000 balls. Or you can get 40% of the total 10,000 balls. And that will still give you the 4,000 balls. Kinyua, I hope now we are okay. If we are not yet okay, you can also inform me there so that I repeat. Remember, we are here to learn. This is our learning process. So please don't keep quiet if you have not got a concept. Kinyua, I'm waiting. If we are not okay, I can repeat again. Okay. Okay, thank you. Now, I was saying that assume that we are going to get maybe the redemption from the customers of this, the 4,000. Barawa, mute your microphone. Okay, let me do it for him. Okay, so we are saying that assume that now we are going to redeem, for example, we are going to redeem 30,000 box tops, 30,000 box tops. Now for the balls now. If we are going to redeem 30,000 box tops, then it means that we can show this, assuming now we are having 30,000 box. is what we are redeeming. So if we are redeeming 30,000 boxes, and when we are redeeming this, now the cash that will be received for the 30,000 will now be, we can get the number of balls. If we are redeeming this, then it means that the number of balls here, we divide it by 10, because for every 10 boxes we get 1 ball. So this will give us 3,000 balls. This will give us 3,000 balls. We just want to illustrate that so that we get it clearly. 3,000 balls. Remember, we were told that you get 3,000. You get for every 10 boxes. For every 10 boxes, we get 1 ball and 10 shillings. So if we are having 3,000 balls, it means that now the amount in cash that we would have received, the amount of cash that would have received will now be 3,000 times 10. Sorry about that. 3,000 times 10. Please, if I'm not clear, you just tell me so that I repeat how I've arrived at that. If you multiply 3,000 times 10, that will be, I'm seeing Wedi Kawira typing, but not having the answer yet. That will be 30,000. Okay, somebody is asking me where is 30,000. Now here we were assuming, we are assuming, we are continuing, yes, yeah. But now I want to illustrate a concept of how we can get now the premiums. Remember, in our problem that I posted to you, we have not been told what the customers have redeemed. What the customers have redeemed. So we are assuming that now, if, for example, we are redeeming 30,000 boxes, for example, if we are redeeming 30,000 boxes, that is an assumption. Yes, that is an assumption. So if we are redeeming 30,000 boxes, now remember we were told that for every 10 boxes, a customer will be entitled to 1 ball and 10 shillings on top of it. 1 ball and 10 shillings on top of it. That is what we are doing. So if, for example, a customer is redeeming the 30,000 boxes, so it means that the number of balls that this customer is entitled to will be, we divide the 30,000 boxes by 10, 3 balls. And remember, for every 10 boxes, again, you get 10 shillings. For every 10 boxes, you get 10 shillings. So that will give us, again, we divide 30,000. We divide 30,000 boxes by 10, because for every 10 we are getting 10 shillings, then times 10. That is how we have arrived at here. We divide 30,000 boxes by 10. For every 10 boxes, we are getting 10 shillings. So 30,000 by 10 times 10. So if you divide this, that will be 30,000 shillings now, the cash. But the balls are 3,000. So I hope, Wedi, we are clear on that. If I'm not clear, I can repeat, please. Okay. Okay. Thank you. Now, if a customer redeem 30,000 boxes, now in that case, now what the customer will be entitled to will be 3,000 balls. 3,000 balls and 30,000 shillings. 3,000 footballs and 30,000 shillings in cash. Now we can record this by one debiting cash with the amount here, the 30,000. We debit cash by 30,000. Then we will also have a premium expense. We debit the premium expense. Now the expense in this case, now, if we go back to our problem, remember we were told that now that the premium expense now we will get the premium expense by looking at the football cost in excess of the 10 shillings that is also given. If you go back to our problem, you can go to the chart there and see our problem. We have it. Remember, we are told that we are given the 10 for in exchange of 10 super serial box tops plus 10 shillings. The cost of the football, the cost of the ball is 12.5. The cost of the ball is 12.5, and then minus 10, that will give us 2.5, and then we multiply that by the 3,000 balls. We multiply this by 3,000. So if you multiply that, we will get the premium expense. So we also debit the premium expense. So the difference here, the 12.5 minus 10 gives us 2.5. So that Wedi Kawira 7,500. Prudence Mithika 7,000. Asarian Kinyua 7,500. That is good. Itkech is also typing. Okay, 7,500. So that is the entry to be made. So we debit cash 30,000. We debit premium expense 7,500, and then we credit inventory of premiums. We credit inventory of premium. Sorry about my pen. So I'll write in short. Inventory of premium. Now this we get by multiplying the cost of now the 3,000 balls. So you multiply 3,000 times 12.5. $3,000 times 12.5. So I'm waiting. You multiply 3,000 times 12.5, 37,500. Okay, Wedi, Prudence, Asian, Kinyua, Dennis Kipkech. Okay, that is good. So that is the accounting entry that is expected. I'm seeing Phyllis. Welcome, Phyllis Kisengi. You have been quiet, but you are now active. Thank you. Now, if we are redeeming any number of balls, we should be able to uh, record the entries the same way we have done here. So what you'll do, first of all, you'll determine the number of balls, and you'll also determine the cash that you'll receive in every circumstance. And then the entries to be made will be cash, you debit, the premium expense, you debit, but now the inventory of the premiums, you now credit. Remember, these accounts, they should balance. You should not have 30,000 here and 37,000 on the other side. Any question before we continue to our last item? Okay, if there is no question, our last item is litigation. It is a law term. Litigation, claims, and assessments. Litigation, claims, and assessment. Sorry about my pen. This is A. And assessments. Don't worry about my handwriting there. Now, the accrual of loss contingencies for a threatened litigation or a claim or an assessment is appropriate if maybe one, the cause for action occurs by the date of the financial statement, and number two, if the information available before the issuance of the financial statements indicates that it is probable that an asset has been impaired or a liability has been incurred. And lastly, if it is possible to make a reasonable estimate of the amount of loss that may arise. Now, there are factors that can be considered in determining the probability of an asset being impaired or a liability being incurred. And this will depend maybe on the opinions or the views of the management or the legal counsel. Remember, this is now concerns now the lawyers and the legal counsel of a company, or even the advisors or the experience of a company in the previous similar cases. Now, the factors that we are looking at will also depend on the decision of the management as to how the company can respond to a lawsuit, a claim, or an assessment. Now, if there is evidence available before the issuance of the financial statements that unfavorable outcome will come from the defendant, then it cannot be reasonably be expected that the defendant will publish a specific estimate of a loss in its financial statement. Now, to do so could weaken the company's position in the litigation. So therefore, there should be a footnote, a disclosure of the contingencies that is associated with the litigation. So what we are trying to say in simple terms is that if there is a case that maybe a customer has decided to sue the company, then the company management should look at now all the factors that are available to them. By doing so, they can look at maybe the past cases that they might have had with the previous customers and how they were able to go about the cases. Remember, not all the cases can be solved in a court of law, because in most African countries, cases take a long period of time to be resolved. So a company may decide to sort the case out of court. Now it will depend on the management and their maybe the company legal secretary on his or her advice to the management. But in most cases, from experience, most of the companies, they usually prefer sorting the cases with the customers out of court. Because, you know, one, if a case goes to a court, for example, then the image of the company will also be dented in one way or another. Even if the customer loses the case or if he wins, the image of the company will be in question. So most companies usually try as much as possible to sort the cases with their customers out of the court. Now, I want us to stop there for today in our live session. And I want us to move to our discussion forum. I'll create it in the next minute and post a problem there, which I'll be waiting for you to attempt. And also there are some exercises that you will also attempt. You don't need to collect them. It is just to refine your knowledge. Any difficulty that you will incur, you can inform me through my WhatsApp or through my email, which is available on the portal. Remember, this session was also being recorded, and